Smart money created this honey trap before taking sell-side liquidity. At first glance, this market looked ready to continue moving higher. Structure looked strong, momentum looked clean, and many traders were confident about buying. But what happened next trapped a lot of traders. Because this move was not a continuation. It was a carefully built liquidity trap. In this video, I will show you how the market broke structure, returned to a key point of interest, created a honey trap for buyers, and then dropped straight into sell-side liquidity. But the real question is, where did the trap actually begin? Let us start with the first important clue the market gives us on this 1-hour chart. Right here, price breaks the previous structure. This movement looks strong and convincing, and this is exactly the type of breakout that attracts many traders. When most traders see a break like this, they immediately assume the market is confirming the direction and will continue moving the same way. Confidence begins building quickly. But experienced traders understand something important. A break of structure does not always mean continuation. Sometimes it is simply the first step the market uses to build a much larger setup. So instead of chasing the breakout, the real question becomes, what is the market actually preparing next? Now, after the break of structure, something subtle begins to change in the behavior of the market. At first glance, many traders still believe the trend is strong and will continue in the same direction. The confidence created by the previous break is still influencing their decisions. But if you slow down and carefully observe the price action on this 1-hour chart, you start to notice a shift in the rhythm of the market. Momentum is no longer as aggressive as before. The candles begin to show hesitation, and the movement starts to lose its previous strength. This is what we call a market structure shift. It is not always obvious immediately, but it is the moment where the market slowly begins to change character. For retail traders, this shift often goes unnoticed because the previous breakout is still fresh in their mind. They continue expecting the same direction to continue. But for experienced traders, this change in behavior is a signal to become patient and start looking for where the real setup might form. Because if the market is preparing a trap, it will usually guide price toward a very specific area before making the real move. And that area is what we call the point of interest, which becomes the next critical piece of this entire setup. Now, this is where the chart starts becoming very interesting. After the market structure shift, price begins moving toward a very specific area on the chart. This area is what we call a point of interest. A point of interest is not just a random zone. It is a location where the market has previously shown strong reactions, and it is often where institutional traders become active again. As price approaches this area, many traders start believing they have found the perfect opportunity. From their perspective, the market already showed strength earlier, and now it is simply returning to a good area to continue the move. This belief begins attracting more traders into the market, and this is exactly what makes the point of interest so important. Because while retail traders see it as an opportunity to enter in the same direction, smart money often uses these areas to prepare something very different. Instead of continuation, the market may use this location to build liquidity and create a trap. So the real question now becomes, what will the market do once price reaches this point of interest? Will it continue moving upward, as most traders expect? Or will it use this moment to create the perfect inducement for the trap? Now, once price reaches this point of interest, something very strategic begins to happen. Instead of immediately reversing, the market starts moving in a way that builds even more confidence among traders. The candles begin pushing slightly higher, creating the impression that the market is ready to continue the upward move. This is what we call a major inducement. The market is intentionally creating a move that encourages traders to enter buy positions. Many traders see this small continuation and believe the setup is confirmed. They place their buy orders and their stop losses below the recent lows. From a psychological perspective, this is the perfect honey trap. Because the market is not just moving randomly, it is attracting liquidity. It is encouraging traders to commit to the wrong side of the market. And when enough traders are positioned in the same direction, the market finally has what it needs: liquidity. At this moment, the chart may still look bullish to most traders, but experienced traders begin watching one specific thing very closely. Because once the trap is fully built, the market usually moves toward the area where the largest pool of liquidity exists. And that area is the sell-side liquidity waiting below. Now, once the inducement is complete, the market finally begins to reveal its real intention. Up until this moment, many traders are still expecting the market to continue higher. The earlier bullish movement and the inducement have already convinced them that the upward move is strong. But if we look slightly below the current price, something very important appears on the chart. Multiple previous lows are resting here. And these lows are not just ordinary levels. They represent a pool of sell-side liquidity. Below these lows are the stop losses of traders who entered buy positions earlier. At the same time, many breakout traders are also waiting to sell once these lows are broken. This creates a large cluster of liquidity, and the market is naturally attracted to liquidity. So instead of continuing upward, price begins shifting direction and gradually moving downward. At first, the move may look surprising, but for traders who understand liquidity, this is exactly what the market was preparing for from the beginning. Because the real objective was never the move upward, it was the sell-side liquidity waiting below these lows. Now, this is the moment where the entire setup finally comes together. The market has already broken structure, shifted its behavior, returned to the point of interest, and created a major inducement that trapped many buyers. At this stage, the real intention of the market becomes clear. Instead of continuing upward, price begins showing weakness and starts moving downward toward the liquidity resting below. For many traders, this sudden shift creates confusion. The market looked bullish only moments ago, and now it is moving in the opposite direction. But for traders who understand liquidity, this is the confirmation that the trap has already been completed. And this is where the sell trade execution becomes logical. Rather than chasing the earlier bullish movement, the focus now shifts to aligning with the true direction of the market. From here, the objective becomes simple: allow the market to continue its move and reach the sell-side liquidity sitting below the previous lows.